Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading weekend ending August 11th, 2023. I'm Preston Brent. Thanks for tuning in. Well, are we still on the buy the dip? We are, but I don't think the dip is done yet. Let's just kind of take a look at where we've been this past week and what I see coming up here through the remaining part of August into September. If we take a look at the week, mostly in the red. The only one in the green was the Dow. Investors it was kind of mixed. Investors weighed a lot of inflation data against worries of a rise in long-term interest rates. So value stocks pretty much outperformed growth stocks, which gave the narrowly focused Dow a little bit of a modest gain for the week. Um, we did see earlier in the week Moody's downgrade 10 regionals and put 5 or 6 others on notice. So that, kind of after Monday's big move, kind of put everybody in just a sour mood. You can see that the S&P, NASDAQ, and Russell all finished in the red. Year to date, very healthy. NASDAQ and S&P still healthy. Dow up about 6.4 and Russell 9.17%. But we saw a lot of closely watched inflation data come in this week. Thursday, we did get a jump in the market price action as CPI data rose 20 basis points in July, bringing the year-to-year over increase to about 3.2%. A little bit below expectations, but enthusiasm over the CPI kind of disappeared as the day wore on. And then Friday, we got the PPI data. It rose about 30 basis points in the month. It was about a tick above expectations. On a year-over-year basis, producer prices rose about 80 basis points, well below the Fed overall inflation target of 2%. So July marked the first annual increase in the PPI in over almost a year. So that kind of set a little bit of a sour tone for the markets as we got some of this inflation data. The PPI did push the yield on the 10-year interest rates higher to end the week. You can see the 10-year finished at 4.09% on the screen. The PE ratio, I think, is still a little bit rich. It's 20.41. That needs to come down a little bit. And I think it will once the markets realize the Feds are serious and fighting inflation. While the markets are only forecasting under 12, 13% of a probability of a rate hike in September. Remember, we do not have a Fed meeting in August. I do believe that the Fed's going to keep the rates higher for longer, and the markets have to adjust to that. And I don't think they have just yet. You can look at the current VIX. It came in the week at 14.84. The prior week it finished at 17.1. So while the VIX did come down a little bit on the week, it's still muted in terms of overall averages for volatility, but still taken up just a little bit, right, over the past month. And we're seeing that in the month of August anyway, okay? You can see the best performer for the week was energy, a little over 3.6%. Same as last week. Energy also led the markets last week as well. Technology was the worst. Communication services are leading the way for the year. Utilities bringing up the rear. Okay. So all in all, just kind of a blah August, which we expect. I'm expecting a little bit of the same thing in the month of September. Members, I'll go through a couple more detailed items for you in our weekly Market Watch Sunday evening. But if we go across the pond and take a look at Europe, you can see over there a little bit of a mixed bag, mostly in the red, though. The only one in the green in Europe was the CAC 40, the French index. But year to date, all very solid with the exception of the FTSE over in Europe. Over in London, up just a little bit. And speaking of London, the UK data showed GDP grew 50 basis points in June. That exceeded their forecast of just 20 basis point expansion. And that kind of helped because underneath the covers, we saw strong increases in manufacturing and construction. And their Q2 GDP surprised to the upside, growing 20 basis points versus the previous 3 months. So, and a lot of that's due to consumer consumption. So it's not that bad over in the UK, or it's bad, but it's getting a little bit better. Maybe there's light at the end of the tunnel. Meanwhile, in the remainder of Europe, the ECB said in its latest economic bulletin that, since the June interest rate hike, developments have supported the expectation that inflation is going to moderate in 23, but still stay well above their 2% target. So, like the U.S. here, they're saying they could keep rates extended higher for a longer period of time, and the markets still remain a little bit uncertain. So they're throwing that out there in the market. So that's to be expected. Meanwhile, over in the Asian markets, you can see the Nikkei slightly in the green. Year to date, doing very well at 24.45%. China and Hang Seng in the Asian markets down solidly for the week. China's up still 3.24% year to date. Hang Seng's down, but they're having trouble. In Japan, we're seeing signs of easing inflationary pressure. They don't want that. They want inflation to be more, right? And they're also showing signs of slowing wage growth as well. Because the BOJ, the Bank of Japan, is still maintaining their ultra accommodative stimulus. Okay, an indicator over in Japan of their intercompany pricing for goods and services, like our PPI, they don't call it that. It rose 3.6% year over year. That's marking the seventh straight month of slowing wholesale inflation. They wanted to stay higher for longer, right? Remember, they've had almost no inflation for a couple of decades or almost deflation, so they're trying to get inflation up. There are also signs that their labor market may be losing some steam as well, as wage growth slowed a little bit in the month of June, but that was just 1 month. We'll see how that plays out. But one thing that it does do is it's probably going to keep the Bank of Japan maintaining their yield curve control, which means the yen is still not ready to blast off yet. Members, I'll go into more detail with you on Sunday. Meanwhile, in China, well, their latest inflation data revealed that their CPI and PPI fell in tandem. First time that's happened since 2020. That's showing a lot of weak demand through the economy. In fact, their CPI declined into contraction territory for the first time since February 2021. PPI was even worse, fell 4.4% year over year, right? So they're kind of in a deflationary kind of environment right now. And that data release kind of reinforced concerns that China's entered into this deflationary period. And that's kind of offsetting some of the optimism as Beijing is coming out with more stimulus for the markets, right, to help boost consumer spending and stuff like that. So they're having a hard time. And I think I pointed out a week or so ago, their exports fell larger than expected, 14.5% in July from a year earlier. That's the weakest reading they've had since the start of the pandemic in early 2020. Now, remember, their exports are being bought by Europe and the US, so is that kind of a canary in the coal mine? We got to watch it very closely. Not only did exports decline 14.5%, but their imports also shrank a worse than expected 12.4%. So the consumers are not spending money there. They are clearly in a deflationary kind of environment at this point in time. So we got to watch it very closely. Like I said, members, for our Sunday night session, I'll go in a little bit more detail. Now let's take a look at the charts, some of the key charts that we're watching here for our weekly roundup. Let me just get a screen up for you guys. It's going to take about, I don't know, 10, 15 seconds to come up on your screen. So just hang tight with me while it comes up. But what you're going to see is the E-mini S&P 500 futures. You remember I've had this on and it's dynamic. As we move forward, these circles get closer and closer together. And you can see we're coming in close to my original pullback point. All right, I had said one pullback point around 44.50. We actually almost hit it on Friday intraday. We came down to 44.59, just barely kissed the 50 EMA and that red line, right? Just barely. And this is the near term pullback point. We may have a little bit of a rally, but then a roll back over again to come to a little bit further out in time, 43.30. It's a little bit lower than it was. But that would be an expectation. And again, it's projecting end of August into September timeframe for a little bit more of a pullback. Okay, now that's just what we've expected and what I've been telling all you guys that we should expect this. If we look at the Dow, it was up 118 points on Friday. But you can see the pullback point here, not as severe because there's a lot of value stocks rather than growth-oriented stocks in the Dow. So it was really the only one that finished in the green for the week. Okay. And then, of course, if we go to NASDAQ futures, it was down for the week. And you could see here, it's still got a little bit of ways to go. It's just barely below its 50 EMA, but I think as interest rates stay higher for longer, it's going to continue to put downward pressure on NASDAQ and the Qs. And this should, and again, it's 2 steps down, 1 step up. So it doesn't mean it's going to go down on Monday. But I think any rally right now is going to be a sell the rally kind of mode in most of these markets just for now. And then if we look at the Russell, it was also in the red for the week. You can see the Russell is near my point. We've kissed the 50 EMA twice. My down move for the Russell short term was 1916.95, and we came almost to the penny on that. Further out in time, not that much further down, right? So I'm expecting some consolidation at this level. The NASDAQ is the one that's going to fall the most, then the Russell, then the S&P, and then the Dow in that order. Okay. And of course, if we come down here and look at volatility, well, the VIX, let me just find it on here. It was down a pretty good little bit on Friday. Okay. You can see we had this gap up and then this move up. Intraday, we were up almost near 20. It was like 18.21. And we're coming down a little bit, but we're in that period of time where we're in this longer term consolidation move. I think the risk of a bigger move in the VIX is upside, not downside. Seasonality wise, September is where we see the VIX generally move up more. Also August and maybe the first week in October, and then we finish the markets with a flurry into the end of the year. So this is a little bit about what I'm looking at with the VIX. And then of course, if we look at treasuries, well, if we look at bonds, interest rates are going up, bonds are going down, right? And I think a big part of this is due to the large amount of issuance U.S. Treasury is putting out there every week, right? You've got other people taking the place of the U.S. government and buying Treasury. We're financing over $1 trillion just in the last 6 months of this year. And in order to do that, you need to have other buyers step up and buy these notes and bills and bonds. Well, when the U.S. government, which doesn't really care about the price they pay, but everybody else does, they're forcing better prices, higher interest rates. So that if this continues, we're going to see the NASDAQ continue to falter, equities continue to struggle, value stocks outperforming growth stocks, right? So that's a little bit about what I'm seeing there. And of course, if we look at the 10-year interest rates, it's up, obviously, because bonds are down. You can see here we're challenging the highs here. And if I step it out just a little bit, you can see the high for the year was at 4.33. You could see this run up here and then a hard run down. I think interest rates will settle in a little bit, but we're probably going to have another run up here before we move down, and that'll be detrimental to the equity market. Okay. Currency wise, if we look at the dollar, that had a strong Friday. It's moving up, but I think the dollar is going to pull back, have a final hurrah up here, and then roll back over again, which is why I want to be long the euro, but not right now. The euro, as you can see, has given up the 50 EMA and is coming back down again. Any rally is going to be sold in the euro for now. You can see there is no divergence in the MACD, so that does not suggest that it's going to go too much lower. We'll watch it closely, but that is kind of what I'm seeing in the euro and the dollar. And then, of course, if we look at the yen, because the Bank of Japan is continuing their yield curve control, the yen is going to continue to come down. If you'll notice, I put a little bar down there. I said that would be an area where we may want to buy it because once they do that yield curve control, once they loosen it, the yen is going to be back up over these levels over here. And that'll be a good run, and it'll be a good play for people that like currencies. Just something we want to watch really very closely. Gold, no, sideways to down. I'm not really interested in gold right now. You can't trade that. My charts are suggesting gold will probably come down and test the 200 EMA, maybe a little bit lower, than find some consolidation before moving back up. Same thing with silver. Copper, because China suffers, so does copper, right? You can see this regression channel here. It spent most of the time to the south of the regression channel. When we tried to lift up above, it couldn't really hold it more than a few days, and then it came right back down towards the center of the regression channel. That suggests that it can run a little bit further to the downside. If I were to mark it, let my system calculate, it's saying, oh, it could get a lot uglier. Somewhere down this level down here. That would mean China gets uglier. That means equity markets through August and September are going to get uglier. So again, that's what we're forecasting. That's what I'm That's what I'm saying the charts are telling me for now. So we got to watch it very closely. Then of course, if we look at energy, back-to-back weeks moving higher. So obviously, oil is moving higher. I got to change my year-to-date number on oil. Has actually made new intraday highs on August 10th. I'll modify that. So we're in the green, but just barely for oil. All right. It's suggesting we'll have a little bit of a dip and then a final flurry higher. But this is going to keep inflation higher for longer, make inflation a little bit sticky. Because if we look at gasoline futures, right here, gasoline futures are up, right? It's trying to break out of this range here. If we break out of this tight range, gasoline futures are going to run, and that's going to keep inflation higher as well. All right, everybody, that's just a quick update on the markets. Members, I'll see you this Sunday evening. We'll go in a little bit more detail on everything and see how things are stacking up. There are a couple of opportunities in the markets that I also see for you that we'll review Sunday evening. Otherwise, have a great weekend, everybody. Members, I'll see you Sunday evening at 8 p.m. Eastern Standard Time. Take care, folks. Ciao now.